Have you ever looked at a company's financial statement, spotted this massive profit number, and thought, wow, they're doing absolutely incredible? But wait a second. Do you really understand a company's true financial health just by staring at those raw accounting numbers? Welcome to this explainer. Today, we're putting financial statements on the examination table and running a full diagnostic.
So here's the big question. Are raw numbers actually hiding the truth? Let's be real for a second. A business making a raw profit of, say, 10,000 rupees sounds amazing in isolation, right? But honestly, that number is totally meaningless until you look at it in relation to what it actually cost the business to make it. And that is the exact core concept we're tackling today.
Let's look at an example to make this concrete. On the one hand, we've got a raw 10,000 rupee gross profit. Okay, sounds good. But on the other hand, what if I tell you that profit was generated from 1 lakh rupees in revenue? When we put those two meaningfully correlated numbers together, bam, we get a 10% gross profit ratio. Suddenly, that meaningless raw data completely transforms into a vital sign of business health. We aren't just looking at isolated figures anymore, we're looking at the relationships between them.
And that brings us to the formal definition. An accounting ratio is essentially a mathematical number calculated as a reference to the relationship of two or more accounting numbers derived from financial statements. I know it sounds a bit wordy, but in practice, what this really means is that we're taking those massive, head-spinning spreadsheets of raw data and translating them into easy-to-digest fractions, proportions, or percentages.
Here's our roadmap for this explainer. We'll start with decoding accounting ratios, then move on to the power and the pitfalls, testing business solvency, assessing day-to-day operations, and finally, measuring true profitability.
Section 1. Decoding accounting ratios.
When calculated the right way, these ratios basically become our fundamental vital signs. It's like a spotlight, you know? They point out the exact areas of the business that desperately need attention, while also highlighting the bright spots that we can optimize. They give us a much deeper analysis of profitability, liquidity, solvency, and efficiency. Plus, they actually allow us to make cross-sectional comparisons with industry standards and help us confidently make projections for the future.
Section 2. Power and the pitfalls.
First up, let's talk about the power. Ratios are brilliant at simplifying complex accounting figures. They establish these clear mathematical relationships that help us assess managerial efficiency and figure out a firm's creditworthiness. The source material uses a really fantastic term here. It says ratios act as a whistleblower. Literally, they blow the whistle to alert management to problem areas early on so they can swoop in and fix them before it's too late.
But hold on, we absolutely cannot rely on them blindly. We have to consider the pitfalls. For starters, ratios completely ignore price-level changes, like inflation. We live in a world where money loses its purchasing power, right? But historical accounting data just ignores this entirely. They also completely miss out on the qualitative, non-monetary aspects of a business. On top of that, they suffer from variations in accounting practices. Different companies calculate depreciation or value their inventory in totally different ways, which makes direct comparisons super tricky. And surprisingly, there's a serious lack of universally accepted standard levels or industry averages to even compare against.
This quote directly from the text really hammers home the danger. It says, accounting data give an unwarranted impression of precision and finality. Wow, think about that. A profit figure isn't some absolute, undeniable truth. It's honestly an opinion based on accounting policies, conventions, and even the personal judgments of the accountant. If the base numbers are flawed or just based on different practices, well, the ratios derived from them are going to be flawed too.
Moving on to Section 3, Testing Business Solvency.
Think of this breakdown like a medical chart. To run a full, comprehensive business checkup, we categorize our ratios into 4 main diagnostic buckets. We check solvency for long-term debt survival, liquidity for short-term obligations, activity for operational speed, and profitability for overall earning capacity. Let's zoom in on that very first one. Solvency ratios are specifically designed to measure whether a business can actually service its debt in the long run. The people who have handed over money to the business on a long-term basis, the lenders, they are intensely interested in this. They really just want to ensure 2 things are completely safe: their periodic interest payments and, of course, getting their principal amount back when the loan period finally ends.
And that brings us to the magic numbers, 2-to-1. This is the standard traditional safety benchmark for the debt-equity ratio, which is a massive solvency metric. It simply means that for every 1 unit of long-term debt, the company should ideally have 2 units of shareholders' equity. If the debt component is small, outsiders feel secure. Less debt literally means a lower chance of bankruptcy. Now, sure, this can vary a bit depending on the industry, but 2 to 1 is widely considered a very safe, healthy, vital sign.
Section 4. Assessing day-to-day operations.
For this daily operational fitness, we look at activity ratios, which are also known as turnover ratios. These measure the speed, the sheer velocity with which various accounts are converted into actual revenue from operations or just plain cash. Higher turnover numbers, that means better activity and profitability. It basically means the business is highly efficient at taking its inventory or the money owed to it by customers and rapidly turning that into actual cash in the bank.
Closely tied to this are the liquidity ratios. If activity ratios measure speed, liquidity ratios are like checking the immediate, right-now pulse of the business. They gauge the ability of the firm to satisfy its short-term obligations as they become due. Essentially, if a massive bill comes due tomorrow morning, does the company have the liquid assets to pay it right then and there without causing a total panic?
Section 5. Measuring true profitability.
Profitability ratios analyze the true earning capacity of the business, and the source makes a really fantastic point here. Earning capacity is the direct outcome of how well resources are utilized. There is this deeply close, intimate relationship between the profit a company makes and the efficiency with which management uses its resources. That is exactly why investors heavily scrutinize these specific ratios.
Let's break this down to see how it builds a complete picture. We have different profitability ratios because, honestly, they tell totally different parts of the story. The gross profit ratio shows us the margin in relation to revenue, like how much money is left over right after you subtract the basic cost of the goods sold. But the net profit ratio, which is usually calculated after tax, reflects the overall efficiency of the business after absolutely all the indirect expenses and taxes are paid out. You really need both of them to get the full story of financial performance.
Which brings us to our final takeaway for this explainer. Raw data is totally silent, but ratios? Ratios are a whistleblower. They tell this incredibly complex story about survival, speed, and true earning power. So the very next time you look at a glowing, massive profit margin, I want you to ask yourself, what is the 2 to 1 reality hiding just beneath the surface? Thanks for joining me on this financial checkup. Keep learning and keep analyzing.